Welcome to Unit 3.8 on Investment Appraisal. In this section, we will explore the methods and techniques used to evaluate investment opportunities. Investment involves purchasing assets with the potential for future profit. Examples include machinery, buildings, land, furniture, electronics, robotics, and vehicles. Investment appraisal techniques help calculate the financial costs and benefits of an investment decision. All investments carry risk, but the goal is to achieve future gains. Investment appraisal methods are often quantitative, making them easier to justify. However, qualitative factors, such as the impact on employee morale, are also important. In this unit, we will evaluate and calculate investment opportunities using the payback period method. The payback period is the time it takes for a project to generate enough profits to repay the initial investment. For example, a copier costing $10,000 and generating $6,000 annually has a payback period of 1.67 years. When deciding whether to purchase an asset, consider its expected useful life. If a copier is expected to last 20 months or more, it is a good investment. Otherwise, it may not be worth it. Investments with shorter payback periods are generally preferred as they pose less risk. However, consistent income streams are also crucial for evaluating the investment's viability. Let's calculate the payback period for a new sports complex costing $1 million, with projected net cash flows over the first 4 years. In the first year, the sports complex generates $210,000 in net cash flow. In the second year, the cumulative cash flow increases to $560,000 with an additional $350,000. By the third year, the cumulative cash flow reaches $1,040,000, surpassing the initial investment. At the end of year 2, $560,000 is projected. Subtracting this from the $1 million cost leaves $440,000 to be paid back in year 3. With $480,000 projected in year 3, the payback period is 2 years and 11 months. The payback period can be stated in years and months. For example, 2.5 years or 30 months. For IB tests, use the format of X years and X months. Let's calculate the payback period for a popcorn machine costing $1,000, with projected cash flows over 5 years. In year 3, the cumulative cash flow reaches $1,100. The payback period is calculated as 2 years and 6 months. Now, let's calculate the payback period for a delivery scooter costing 25 million rupiah, with projected cash flows over 5 years. In year 3, the cumulative cash flow reaches 19 million rupiah. The payback period is calculated as 3 years and 9 months. The payback period method is quick and simple. It helps identify potential cash flow problems and determines when a firm will break even, focusing on short-term estimates. However, the payback period method encourages a short-term outlook, potentially overlooking larger future gains. It focuses on time rather than profit, and monthly contributions may not be consistent. Investment appraisal is a crucial aspect of business decision-making. One method to evaluate investment opportunities is by using the average rate of return, or ARR. Imagine you invest $1,000 and receive various returns over 5 years. To calculate the arranged buy, you need to determine the percent return for each year. Here are the returns for each year. By summing these percentages and dividing by the number of years, you can find the average rate of return. ARR calculates the average annual profit as a percentage of the initial investment. This formula helps compare the profitability of different projects. Let's look at an example. A new computer system costs $400,000 and generates specific cash flows over 5 years. To find the arranged buy, deduct the initial cost from the total cash flow. In this example, the total net cash flow is $700,000. By calculating the average annual profit and dividing it by the initial investment, we find the arranged buy. If the arranged buy exceeds the borrowing interest rate, the investment is recommended. ARR can also be used to compare 2 alternative investments. Here, we have 2 projects with different cash flows over 4 years. By calculating the total profit and arranged buy for each project, we can determine which investment is more profitable. Project Bandung has a higher arranged buy compared to Project Denpasar. One strength of arranged buy is that it enables easy comparisons of profit forecasts for different investment projects in percentage terms. However, arranged buy has weaknesses. It ignores the timing of cash inflows and requires an estimate of the project's useful life. Additionally, the longer the time period, the more likely errors will occur.